When it comes to investing, you don't have to make it super complicated. Sure, you can go ahead, you can research individual stocks, you can look at their balance sheets, you can go in depth with them, and you could buy and hold potential winners, but you could also lose a lot of money over a long time on buying one specific stock. Now, we have a much easier path that I do follow personally. That is the exchange traded funds, or the ETFs. Now, this is a very simple, convenient way to buy really a broad basket of stocks. Diversification in here is a must. And Vanguard makes some of the best ETFs that I have, and most of them I do hold on a personal level. So in today's video, we're going to be looking at 3 Vanguard ETFs to buy and hold literally forever. So let's go ahead and get into this. The first one we're going to be breaking down is the VOO, or the Vanguard S&P 500 ETF. Now, this is one that I actually hold in my portfolio and hold in a big manner. And I want to break down kind of the logic behind it and the reason. So looking at the VOO itself, it encompasses the entire S&P 500 index, which means when you look at the investments of this, you're investing in 503 stocks. You're investing into every sector that the stock market has. Meaning, when you're putting money into the VOO, it is instant diversification when it comes to building it. It is a large blend domestic stocks. Now, one thing to remember with all 3 of these from Vanguard, they are US based. Now, there's a big kind of play, a big conversation that has been had about the diversification of international. When you start thinking of larger companies within the VOO, when you think of Nvidia, when you think of Alphabet, when you think of Microsoft, Apple, all of these large companies are global companies. That is the reason why personally I do not invest into international companies. Is a lot of the larger companies, when we get into the US space, is and really do have an international presence. So let's go ahead, let's break this down. And looking at this over, you can see the overview right here. They have a large blend. Now, looking at the performance, and of course, previous performance is not indicative to what we're going to see in the future, but so far year to date is 24.47%. That is crazy when you look at the growth that we have seen in the S&P 500 this year. That is not typical. Normally, the VOO, or the S&P 500, is running about 10%, even over the last 10 years. I believe is right around 10.6%. So you're getting a 10% return, and also you're getting a very consistent 10% return, which is the reason why I do love holding this fund. Now, the other thing you'll note is the expense ratio. This is incredibly, incredibly low when it comes to the expense ratio, a 0.03. When we start thinking of the variations of this with mutual funds, with financial advisors, you could go ahead and invest in this. Most of the mutual funds are about 1%. If you have a financial advisor, it's possibly 1% or north of 1%, meaning that in the course of your investing journey of your entire life, you could be giving away roughly 30% of your portfolio over, again, the investment portfolio in your entire life if you're utilizing a financial advisor. And of course, if you are going and investing in mutual funds, because mutual funds are managed funds, they have a lot higher price tag along with them. Now, Warren Buffett notoriously has said that everybody should own the S&P 500. Everyone should be into an ETF like this, and they should be into it roughly 80% of your portfolio in the VOO. Now, again, looking at the ones that you can buy in here and really hold forever, I want to break it down at the end of this, so definitely getting through this. So performance and fees. This, again, is kind of the summary that you need to look at. So looking at month end down a little bit, that's okay. Your 3-month, 3.6%. And as we get through here, year to date, like I said, around 20%. 1 year, so looking at the past 12 months, we are up 38% in this, which again is kind of crazy. When you look at the 3-year, you're at 9%, even the 5-year at a 15.21% return. That is incredible. That is a really strong return. And of course, it's because AI has been driven it. Nvidia, Apple, all of these larger tech companies have been doing incredibly well with the growth factor. 10 years, almost 13%. And even since inception, guys, right there, 14.52%. That is incredible to see the growth that we have seen over the last, or since inception. So that's what, 14 years, 14.52%. If you were putting in here and dollar cost averaging into this on a regular basis, you would have a exponentially a much higher return through the dollar cost averaging feature, which is exactly what I did, because there has been a couple years where the S&P 500 has went down a little bit. Now, of course, this is using the average. So when the S&P 500 declines, so let's say looking back at 2021, when we started seeing the S&P 500 actually pull back, buying during that time. And again, going back to Warren Buffett's philosophy, when there's blood in the streets, you buy. when things are red, that is the time you should be buying. That is where you're getting it discounted. For instance, with this ETF, looking again a couple years ago, when you start looking, and I believe we can do annually, when you start looking at some of these years ago that are right here. So 2022, you can see we were down 18%. So think about that. If it is down 18%, every single dollar you're putting in there, you are getting an 18% discount on the investing in 2022. Now, for me personally, I dollar cost average every single week. For the entirety of 2022, I invested time and time and time again every single week for 52 weeks, meaning when the market recovered the following 2 years, it has been incredibly strong. Very good returns. We are almost at 100% return in 3 years through dollar cost averaging, which again is kind of crazy. Now, when you start looking at the expense ratio, again, a 0.03, definitely very good when you compare it to the average for very similar funds. When we start looking at the price is what it is, guys. When you start buying into something like this, you're not going to come in, you're not going to buy the whole ETF shares unless, of course, $538, but it is fractional shares. And even looking down below, I have a link to M1 Finance where you can invest in fractional shares. So again, looking at the prices and where it's built, definitely doing well. But when we start looking at this, again, 504 stocks are within here. That is because some companies do offer 2 different kind of stocks, which are the same stock within there. Not a huge return when it comes to the dividend ratio, but when you start looking at the sectors, this is where it is market weighted, meaning for those information technology, those IT companies like your Apple, your Nvidia, your Google, all of those, and you can see right here, the VOO 31.5 or 0.70. So almost 30% of your entire portfolio is in in information technology. So making a really big weight. And you can see the benchmark here. It tracks the benchmark. It tracks that S&P 500 index. That's exactly what we want to do. But you can see with all of the sectors, it is instant diversification through everything, meaning that the highs and lows will not be as high or low because it is not driven. We're not putting 100% into IT or information technology. We have it balanced out with a lot of other sectors in here, making it very important and really diverse when it comes to building this one out with the VOO. Now, the second one we get into is the VOO's little brother, the IVOO. This is the Vanguard S&P Mid Cap 400. So we are no longer looking at the S&P 500, which of course is the 500 largest companies in America. We are looking at the mid cap. Now, these do have a special parameter to fall into this mid cap. So I really want to break this down. And if you remember from where we were with the VOO, when we start looking at this overview, this is returning 16.61% so far year to date. So doing very well in the return, not quite as high as that S&P 500. And the reason for that is the tech stocks that are driving that. This, of course, represents 400 medium-sized companies in the US. So when you think of the convergence of having both that S&P 500 fund and then this mid cap, you are looking at your 500 companies plus your 400. You have 900 companies in the United States that you're going ahead and you're investing in. Now, the market price for this one, quite a bit lower, but when we start looking at the summary, very similar to what we've seen with that S&P 500 fund, we are at 32%. And then, of course, the 3-year at 5%. The 5-year is at 11, and the 10-year is almost at 10%. Since inception, 12%. So still not quite at the 14% that we're seeing the run rate with that S&P 500, but the mid cap does hold its own value because you are outside of so heavily vested and so heavily invested into those large tech companies, where again, if we don't see AI take off like it was, if we see a pullback in semiconductors or anything when it comes to the IT sector, this can make a big difference and this can actually perform a lot better. And traditionally, depending on the market, depending on the economy, the mid caps and the small caps have performed incredibly well. Looking at the price, significantly cheaper to get into this one. And then, of course, looking at overall the index and the way that this is built, I want to go through the portfolio because we have 401 stocks here. But overall, again, growth rate about 15%, so pretty good. Now, the big thing to note with this is the mid cap. Before it was a large blend when we seen the S&P 500. This is the mid blend using a lot of these companies. And you'll also notice the P&E ratio. This is the big difference. When it comes to the profits and earning ratio, it is significantly lower than what we see, again, of those really high tech companies, which can be a little bit cautious because a lot of people are saying that those larger tech companies are very overvalued, meaning there's not as much room for growth with those. And these mid caps have a lot of room and a lot of runway to go ahead and build those. Now, of course, it goes through the risk, but looking at our sectors, information technology, 9%. This is the difference. When you think of that S&P 500, we were at 32% for the information technology. This is not reliant. So again, if we see a pullback from the IT sector within that S&P 500, we are not going to feel the effect, and we're not going to see as down of a market than we've seen before. We're a lot more focused in this one in the industrials. As you can see, the financial, discretionary spender, consumer discretionary. So that makes up a big bulk of this when it comes to the companies. And of course, these are not the mega cap companies that drive the S&P 500 or drive the economy itself. And the third and final one we look at is VB, which is the Vanguard Small Cap ETF. So this one is looking at the small cap. Expense ratio on this one, a 0.05, so still super cheap when it comes. Now, you also notice right here, Admiral shares, all of these do come in a managed mutual fund. Mutual funds do come, again, with a little bit more of a cost associated with it. When we look at the overview of this one, you can see doing pretty well, even doing a little bit better than we've seen with those mid caps. Small caps and small, really, companies have a lot of room for exponential growth. These are the companies, even looking again, thinking mid cap and small cap, these are the companies that support a lot of those larger cap companies that are your tier 2 or tier 3 suppliers, even thinking of like the big 3, or really developing and building, they're the backbone really of the United States with these companies that are supporting all of these larger companies and the growth aspect that they do have in there. So breaking this one down with our performance, overall, you can see a little bit lower over the last 20 years. So we are going back another 6 years, which of course, this does include the housing market 2007, 2008, because if you looked at the S&P 500 fund, it was 2010. So this does go back 6 years earlier. So a little bit further down for that reason specifically. But when we start looking again at some of the pullback, and when you start looking at the annual growth, it is not as far back, and it doesn't pull as far back than we see with those S&P 500 funds, but it also doesn't peak and doesn't have as many of those very, very high gains. You're not up, 20, 30, 40%. It is more of a relative kind of solid, steady growth within the smaller caps. Now, when you look at this one as well, there are a lot more companies when we go through and kind of break this down. You can see there's 1,383 companies. But when you think of your portfolio composition, this is very important. So large cap, mid cap, small cap, we are building and really having the blend of all three of these Vanguard funds. So when you think of the entirety of the stock market itself, you are building everything out itself. So a lot of people will ask, why don't we just invest in the VTI? Now, the VTI is the Vanguard Total Index, meaning that it includes the large cap, the mid cap, and the small cap. The reason being, with these three ETFs specifically, you can build a portfolio that kind of encompasses everything, and you can do it at different percentages. Now, for me personally, if I was putting in something like this or building a portfolio of this nature, I would look at something like that Vanguard S&P 500. That would probably be roughly 60% of my portfolio. When we look at the large cap, when we look at the IT, when we look at the ability for it to really grow, 60% of my portfolio would go into that S&P 500 fund. The other 20% I would put into 20% mid cap, 20% small cap, meaning that between the mid and the small, you have 40% of that portfolio built in. If you set that portfolio, it is literally a portfolio that you could really set it and forget it. And when you even break out this, again, a little more of a focus on the industrial, we're looking at the healthcare market, the financial, the discretionary spending, and a lot less of that focus when it comes to technology. But overall, when you think of building a portfolio and really having the ability to go into those large S&P 500, those large companies, the mid companies, and the small companies, it does make a big difference on how you break it up. That is the reason why, again, you could choose something like the VTI, put 100% in there, but a majority of it, because it is weight-based, you would be putting a lot more money into those large tech companies, which is the reason why breaking it into 3 individual ETFs like I did here today in this video makes a really big difference when it comes to the growth and really the development that we see overall. So guys, that's going to do it for today's video. Let me know what you guys think about the Vanguard funds. And as always, thank you guys for watching.